If you have losses in your investment account, you can actually realize those losses and use a portion of those losses to offset some W-2 or self-employment income, which is a huge tax benefit. But the IRS has a slew of rules surrounding how this annual loss deduction work. So in this video, we're going to be covering 5 things. The first thing we're going to be covering is what the annual loss deduction limit is each year. Does it impact whether you're a single or a joint filer when you file your taxes? Knowing the difference between short-term and long-term losses and how they affect this deduction limit, understanding how carry-forward loss rules work, and also understanding how the wash sale rule works. Each year, the IRS allows you to realize $3,000 worth of investment losses and then use that $3,000 loss against any type of earned income that you may have. Now, this is out of the ordinary because usually investment income is considered passive income, where earned income is like W-2 self-employment, and usually one does not offset the other. So this $3,000 annual deduction amount is one of those exceptions where you can use passive income from your investment accounts to offset ordinary income over on the W-2 self-employment side. In order to capture this tax deduction, you actually have to realize the loss of the security, which means if you bought Apple stock and it just happens to be down, but you haven't sold it yet, that's still in an unrealized loss status. You actually have to sell the shares at a loss to generate the realized loss that can now be used as a tax deduction. But also important, it has to be done in a taxable investment account, like a brokerage account, joint account, Rev Trust account. If the money's sitting in an IRA, SEP IRA, 401k, that is a tax deferred account that does not generate any realized losses for tax purposes. It's also important to understand the difference between short-term losses and long-term losses. So short-term losses means you bought a security and sold it within a 12-month period. That's a short-term loss. If you bought a security and held it for more than a year and then realized it at a loss, it's a long-term loss. Now, the reason why it's good to understand the difference between the two is short-term losses can be used to offset short-term gains or long-term gains, where long-term losses, so the ones that have been held more than 12 months and you realize a loss, those cannot be used to offset short-term gains. They can only be used to offset long-term gains. Now, why does that matter for this tax deduction strategy? It matters because both short and long-term losses count towards that $3,000 annual deduction amount. So if we could pick or choose whether we want to use short-term losses or long-term losses towards this $3,000 annual deduction, we'd kind of prefer long-term losses. The reason being this, because short-term gains are taxed as ordinary income. So if I use short-term losses to offset short-term gains, I'm getting a benefit that's taxed at an ordinary tax rate versus if I use long-term losses to offset long-term gains, those long-term gains were going to be taxed at preferential long-term cap gains treatment. So I'm actually not getting the best tax treatment over those long-term losses. I would rather use those long-term losses to count towards this $3,000 deduction against ordinary income, which is taxed at ordinary income tax rates. But what if you sell something that has a $10,000 long-term realized loss? I can use 3,000 of it this year, but what happens to the other 7? You don't completely lose it. So if you don't have other long-term gap gains to offset by that loss, you can use what's called the carry-forward loss rules, which says if you only use $3,000 of that long-term loss for your tax deduction, the other $7,000 will carry forward to future tax years, and you can use that carry forward to offset future gains or use it in a future year for that $3,000 tax deduction. We'll get the question sometimes, does it matter whether you're a single filer or a joint filer? Do single filers get $3,000 and a joint filer, because there's 2 people, get $6,000? The answer is no. It's $3,000 whether you're a single filer or $3,000 whether you're a joint filer. The only exception to this $3,000 deduction amount is if you're married filing separate, then you only get a $1,500 deduction for this investment loss exception. Now I want to warn you about the wash sale rules. So while most people wait until the end of the year and they look at their taxable investment accounts and say, okay, where can I find $3,000 worth of losses? If they sell something, but then want to buy that security back, they have to be very careful of the IRS 30-day wash sale rule, which says if you sell something at a loss and then you buy that same security back or a substantially identical security to that one that you sold within a 30-day period of the sale, that loss no longer exists for tax deduction purposes. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.